as rates continue to rise and the tech sector is, as we've been watching all week, on edge. Let's bring in David Katz, Chief Investment Officer at Matrix Asset Advisors. Also, Guy Labaz here. He is the Chief Fixed Income Strategist at Janney Montgomery Scott. Good afternoon, I should say. I was going to say good morning. Good afternoon to both of you. David, I'm going to start with you. Can Jay Powell control this situation? And is it a problem that he's effectively not saying that he has any ambition to do so?
On a daily basis, the answer is no. On a intermediate term basis, if the Fed keeps rates at zero or near zero, they can provide a lot of liquidity to the market, and we don't think the market should get overly concerned about the Fed's actions. There are other things to worry about, but not the Fed in this case. Okay, so
but before I get to Guy, the rotation we're seeing, you think is not Fed related then?
Well, but the Fed is doing what the Fed is supposed to be doing. The rotation that we're seeing, we think, makes perfect sense. If you look at the last 14 recessions and the aftermath of the last 14 recessions, value has outpaced growth. Last year, you had an enormous overvaluation in a lot of growth in technology stocks. As the world is normalizing, as the economy is opening up, some of those stocks are coming back to earth. We think that makes enormous sense. The S&P is at 21, 22 times earnings. There are a lot of value areas, a lot of sectors in the market that are 14 to 16 times earnings. Money is starting to go to them. We think that is a much more sensible thing, and we don't think it's the Fed's job to try to control the stock market. Their job is to try to help the economy and to try to allow for liquidity so that none of their actions are hurting the overall economy or businesses.
Guy, what do you think about what David just said?
Well, I think today is a really great sort of microcosm to almost pay attention for the broader equity fixed income markets to just how myopically we seem to be on Fed policy. Now, this morning, the Fed made a relatively modest regulatory announcement that's probably going to have very minimal effect, certainly very little effect, if any, outside the banking sector. And yet we have this massive instant market reaction and sort of breathless commentating on the matter in the morning. So when it comes to the long end of the yield curve, to some degree, it's a similar story, right? Most of the drivers of long-term interest rates aren't going to be what the Fed does on a day-to-day basis. It's going to be where inflation moves. And what the Fed is doing is simply allowing it to move higher, in theory, should those pressures eventually emerge, allowing it to move higher than perhaps in prior cycles. Now, I don't think this needs to, without at least unhinged trading on the long end of the curve, which we're very far from. Without that, I don't think it needs to have a negative feedback effect to the equity markets.
Shepard Smith here. Thanks for watching CNBC on YouTube.